Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
We are glad to be with you, talking about financial matters as...
Yeah.
And,
you know what I did this week, Scott? I took some of my own advice and I did my Roth rollovers, my non-qualified this week for both 25 and 26. And then
you did it or your wife did it for you?
I did it.
I
sent an email to my client service representative at Allworth Financial and said, hey, can you do this?
This is the concept of if you don't have any other IRAs.
Other than Roth IRAs.
If you don't have other, you make and you can't qualify for making a Roth contribution, you contribute to a non-deductible IRA, and then you immediately convert that to a Roth IRA.
That's correct.
And because you didn't take the tax deduction, the money that you put into the IRA has already been taxed, and so therefore, when you convert it to a Roth, it doesn't trigger any additional tax bill.
Up to your 100% of your earned income, not to exceed the maximum. I point that out because my daughter had been doing it for years, and then when she went to law school, I think under my advice, maybe I had forgotten she didn't have income, and then she did it, and we had to back it out.
Oh, in one particular year.
Yeah. But I do it, and I think
I've done it, but it's I was almost wondering if it was worth the hassle.
I did it this year, but then I realized...
And the reason you did... So Pat did it for the calendar year of 2025 and calendar year 2026, which he has up until April 15th to make a contribution for 2025, convert the two. And then you don't have to worry about doing this next year. You do it every 2 years.
Every 2 years, yes.
In the springtime.
That's right.
As you're doing the planting the garden, doing the spring cleaning, and you do the Roth stuff.
And then checked our insurance limits, rebalanced the portfolios, and... Then I was asking my wife about subscriptions, like and we realized that they had moved some of the subscriptions up, the price on them up.
You're kidding. I had no idea they would do such a thing.
They just do it.
Wow.
I had to get on the phone and tell them, I told the machine I want to cancel, and miraculously someone talked to me and they said, it was quite funny. I was actually traveling with my kids in the car, and I had them on the speakerphone. I gotta go get this done while I'm driving, and the lady said, we can move it to $24.95, and I said, well, that's just way too much money. I don't want to spend more than $4.95 a month. And she said, I'm going to put you on hold. I'm going to check with my team. This is for a newspaper subscription. They have a huge team. Apparently, they run it.
Hey, let's gather up. Pat McClain's on the phone. He doesn't want to pay $25 a month. Should we allow him to do it for $5?
For $4.95. I used the same numbers. And then she came back and I said to her, what did the team decide? And she said, the team decided that we're going to let you have it for $9.95. And I said, well, perfect. Thank you.
She just put you on hold for a minute. She's highly trained. Keep the customer at all costs. It's just a digital subscription, right?
Yes.
So zero cost to them.
That's right.
So any revenue is better than no revenue.
That's right.
50 cents a month would be better than nothing.
That's right. It all goes to the bottom line.
And now you just shared across our whole listenership how to get a discount on their newspaper.
Well, remember to thank the team.
You're not. I have a feeling I know which newspaper it is.
Yes.
I don't think it's the Wall Street Journal.
No.
But anyway.
So, and the reason I mentioned that out is because it's early in the year, and we have mentioned this, and I try to get through all this stuff.
It is time, like if you've got a 401k, you want to max it out.
Oh, I did. I increased my contribution because there's an increce in contribution.
Max
my
out
pay
the
didn't go
401k.
up, but...
you didn't get a merit increase?
No.
I got the same merit increase as the year prior and the year before that, too.
No merit increase for Pat or Scott. The team decided.
But those sort of things, the FSA, if you qualify for that, any of those HSAs.
Yeah, but I had to set a deadline for myself because I've lived with myself a lot of years, and if I don't have a deadline, I will not get it done. So, rather than wait until February or March.
Yeah, and we've talked about this recently, but it was interesting. This has to do with Social Security. And I think if you've been a listener to this program for a while, you know that our thoughts are, if you've done a great job savings, you enter retirement with substantially more money than the average American, there's a chance that there'll be a reduction of benefits to you in the future.
Yes, because their choices are limited.
Yeah. And this next election cycle, the senators that are being elected are going to be forced to deal with this.
Yes.
That's how quickly it's coming. 7 years from now or so, the Social Security Trust Fund becomes insolvent. And currently there's an across-the-board reduction in benefits of 20-some-odd%.
Which you can say it's never going to happen, and you'd be right. And the reason is it's a welfare program. It wasn't designed to be a welfare program, but it has become a welfare program, which means what you put in and what you get out don't have to align. And so the new group that's coming in, the congressmen, they have to.
Senate, yeah.
Oh, I'm sorry. They have to. Right? And so we talk about it time.
It'll be interesting.
All the time.
There's a good article in somewhere.
Wall Street Journal.
Yeah, beginning of the year. It just talks about, and it's a variety of different senators were weighing in. It's like everything's going to have to be on the table. Increasing payroll tax, which right now it's $180,000 a year.
But remember, the
benefits are capped.
Yeah, but the benefits were capped on Medicare taxes years ago, and they made those.
There's no cap on that. Yeah, Medicare, that's right. There's no cap on that. And
it used to have a cap on it, though.
And I would argue that Medicare is now means tested.
Correct.
In that the higher your income is, the more you have to pay for your Part B.
Means testing. Yes.
Yeah.
It's not the same benefit across the board. So if you're applying for Social Security, if you don't need the money, take Social Security, because it's the benefit that if you don't need, you're the one most likely to lose.
Average Americans should wait till age 70. Your typical American.
But that's exactly the opposite of really how it works. If you look at the statistics, the people that don't need it typically wait longer because they look at the economics, and it's not just driven by economics, it's driven by policy.
Right. That's exactly right. And you're making a bet on policy. We all are on if we delay our Social Security. So anyway, it'll be interesting to see what happens, and we'll look at it as time goes on. We're going to take some calls here, but if you want to be part of our program, we love taking our calls and questions from you, our listeners. To join us, send us an email, questions@moneymatters.com. Again, questions@moneymatters.com. Or you can call 833-99-WORTH, and we'll get you scheduled on. But let's start in California talking with Susan. Susan, you're with Allworth Money Matters.
Hello.
Hi, Susan.
Hi, Scott and Pat. Thanks for taking my call. Love the program.
Thank you.
Whether it's podcasty or whatever.
Okay.
Okay, so I don't hear a lot of talk about this kind of stuff because there's a lot about saving up for retirement. There's but I'm looking at seeing if I have any good ideas about tax efficiency now that we just recently completely retired, and we had partially retired but still had money coming in all the time, and then we augmented the part-time, and now we're completely done.
Okay.
So now I think about this more. So
how old are you guys?
We're both 69.
Okay.
And I'm also factoring in, the go, slow-go, and no-go aspect, too, because this is the whole thing. Okay. So do you want me to give the detailed things
Yes. Sure,
first?
please.
Okay. So we will have a $110,000 annual income, of which $2,600 is pensions and $6,300 is Social Security, if your lump of both together.
Okay.
And then we have a little bit of stuff that comes in, and that's what makes it to 110. We are going down in tax bracket from where we were, which is nice. Currently, we're living just on stuff we had saved up and that kind of thing. So this year, we're only going to be about $93,000, and then because I started taking my Social Security. I got my first check in April.
Okay.
And so anyway, so that's where we're at with that.
How much money do you have in IRAs?
About all those kind of things, 403Bs, all that junk, about 1.2.
And how about brokerage accounts?
0. I don't even have a brokerage account. That's part of this question.
All right. And
How
then
about savings? Cash in the bank?
Savings about 100, about half in cash and half in I-bonds, CDs, savings accounts.
so the $110,000 in income is made up of Social Security and pension income. Is that correct? And you
Yes,
said
and
a little bit of
yeah.
a little bit of what?
We're in a real estate group that we've been in for a while. I don't know what it's called. Like, it's a private thing. And anyway, and we get about $300 a month from them.
Okay.
On a quarterly basis.
Okay. And what's your question for us?
Okay.
Your home is paid for, I'm assuming.
Yes, our home is paid for. We have no debt. So some of the ideas I was wondering about, because right now we're traveling and that's why we only have $100,000. Anyway, but we're having a good time. Every year we should at least pull out enough from our 1.2 thing to come up to the end of the 12% tax bracket.
Yeah, you're right about there.
I think you're going the right direction. When you said take the money out, I would convert it to a Roth IRA.
No, I would disagree with that.
Why?
Because, okay.
Would she spend it?
Yeah, I think you should spend it.
Ah, that's a good point.
I mean, you're talking about
also,
traveling. You're just retired.
You're 69.
I mean, what would not make sense is saying, oh, let's defer that trip till next year. Let's defer that trip to 2026. Let's defer that trip to 2027.
And it's not.
Right.
It won't be that much, 20 or 30.
Correct.
Yeah. Well, that's a lot of money. I don't want
but
to.
if you took it, let's say you started with a 3% withdrawal on this.
And started spending it.
Yeah.
I'd be okay with that. We're getting to the same place. The Roth
I
conversion.
mean, if you were my older sister, that's exactly what I would tell you to do.
Okay.
Either that or you just let your retirement accounts continue to grow until then you have required minimum distributions.
But then that's when you would do a Roth conversion.
Yeah, but that also means I'm not going. I might be into slow going.
No, that's right. That's what
that's only 4 years away, but
that's Scott's point exactly, which is start the distribution and spend it.
Look, even if you said we want to do extra travel in the next 24 months or whatever the time frame is, and we want to spend a little more than we typically would, I have no problem with that either. I mean, you save these dollars for this stage of your life. The reality is,
we're here.
We're here. You're 69. Odds are at least one of you is going to be alive into the 90s, if not both. Statistically, at least one of you will be alive in the 90s. So we need to make sure we have income for that. But you've got Social Security and pension, and you've got quite a bit saved relative to the amount of income you already have coming in.
And by the way, it's the pension income that makes you comfortable saying spend this.
Sure, because it's like that net whatever present value that I learned from you guys too.
That's right. Yeah.
But can I ask you my quick 4 things so that, because what my plan was to not go into the 22% tax bracket very much, because I don't like to do that. I'd rather do other things.
You're going to be in in a couple years now, you'll be forced to be in that bracket. And then
exactly. That's why I thought it's good now to take some out, because at least it'll be a little less. Yeah, no, I know, because, we're going to be way over by the time we get there.
Yeah, that's right. So it wouldn't be the biggest driver. It's good if you could stay out of it. But if you said, hey, I want to go to the Amazon, but I'm not going to do it because it drives me into a 22% bracket, I'd say that's a mistake.
Okay, but can I ask you these 3 things? You can go real quick through them. Okay. So I have a question about tax loss harvesting. I'm guessing there needs to be more churn, because your cost basis is what determines whether you have a tax loss harvest.
It doesn't. All your money's in a qualified plan. There's no such thing as tax loss harvesting.
Unless you have a mutual fund or stock that you're holding outside of your retirement accounts.
If it's inside the retirement plan, you can't do any tax loss harvesting.
Oh, that's beautiful. Okay. And then, so it'll only count once we start taking the money out and putting it in the brokerage account that I'll start.
One of the downsides of retirement accounts is everything is taxed as ordinary income.
Right.
So if you bought NVIDIA stock and Apple stock 20 years ago in your IRA and you made a killing on those two stocks, rather than having a capital gains tax when you sold them, or even a step-up basis if you held it to death, you would have it's all going to be taxed as ordinary income, either while you're living or at your death.
Beautiful. Okay. So then once I put them in the brokerage account, then if I have a loss, then I can do that. Okay. That's one. Second thing is gifting to children. When you do that out of a retirement account, that's still taxed as ordinary income.
Yeah, unfortunately, again, if you owned a stock and you said, I want to give $10,000 or whatever amount of stock to your child, you can gift that stock. There's not any tax consequences for the gift if it's under the limits. And then your cost basis would just carry forward to theirs. With a retirement account, unfortunately, you say, I want to give my kids 10 grand. When you pull the 10 grand out, that $10,000 is going to flow through onto your income tax return. It has to be included on your tax return, and then you gift the proceeds to your children. So it's not necessarily ideal.
Next one is qualified charitable distribution accounts. If we were going to go above too much into the 22, could I use that much and put it in and start a qualified charitable distribution account, or is that again pulling it out of retirement, paying money on it, and then doing a qualified?
So that only takes place once you qualify for your RMDs. Required minimum distribution. So you can't do it now.
I think you can do it at 70.5 still.
Oh, that's right. That's right. Thank you. But they still can't do it now. And it goes directly to the charity. It can't go to a charitable trust, then you distribute.
Yeah, it can't go to a donor advised fund.
It has to go directly to the charity.
That's
Are
right.
you giving money to charities now?
Yes.
Okay. Well, then it would be.
Well, then once you, at 70.5, it would make sense for you to have, like, let's say you give money to your church or March of Dimes, whatever it is. Like if you just did that once a year and had the money come from directly from your IRA, would be more beneficial to you.
A good idea. Okay. Finally, as we move along, and hopefully we're just going to keep sailing through, and I'll die when we're taking a nap when we're 95, but that might not happen.
That's exactly what's going to happen, Susan. You and your husband, when you're 95, are going to go take a nap.
Yes.
You're going to finish watching reruns
come up and say, Grandma. That's what's going to happen.
Yeah.
Anyway.
Okay.
But my last one is there any reason we should do a QLAC, qualified longevity annuity contract, as we move along? Is that something you do within your IRA?
You're talking about longevity insurance. I wouldn't, because the size of your pension and your Social Security.
Okay.
Yeah.
That sounds
And insurance is always a cost to insurance.
Yes.
So as long as we can project, as long as we don't spend down that IRA and have that IRA continue to grow. So if you take, say, a 3% distribution off it, and you're, say, a relatively balanced portfolio, you should have growth above that. I mean, historically, stocks have done about 7 percentage points above that of the rate of inflation. So if, let's say, your 50-50 portfolio, maybe some real estate or whatever, if you can plan on, saying, earning 3 to 4 percentage points above that of the rate of inflation, that means you can pull out 3 to 4 percentage points every year and
still keep up with inflation.
Yeah. I mean,
And
obviously,
then
on an annual basis, your account's going to float all over, but over a long period of time.
Yep. And I can start right now this year, but once we get to RMDs, we'll be getting so much money, then I shouldn't take a 3% anymore, right?
But you just talked about the qualified charitable distributions too. So you don't have any choice. You have to take it.
It's going to be about 3.5% when you hit age.
Yeah. So you don't take what we're telling you now and the required minimum distribution. We're just saying you can start taking money out
for
early.
right now.
Yes.
So 3%.
So appreciate the call. Congrats on the full-time retirement.
Yeah.
Thank you so much. I appreciate you a lot.
All right,
thanks,
enjoy.
Susan. Wish you well. We're now going to Colorado and talking with Renee. Renee, you're with Allworth's Money Matters.
It's fun to be able to talk to you guys. I listen to you on your podcast, but it's very fun to actually talk.
Oh, good.
Well, thank you.
Just listening.
Yeah.
Thank you. What can we do for you?
Well, I'm a really nice person. I just want to tell you that.
Okay.
And
Now I'm suspect. Because if you...
I have a hard...
Do you think the Pope says, believe me?
Well, I have a hard time saying no to people.
Okay,
And
well, that's
so,
something different.
okay. That's
You're
where
easily
my
sold.
Yes. Okay. I have 5 different financial planners, and I need to know how to get it down to one. How do I do that? And then are there going to be penalties if I change accounts into one?
Okay.
All 5 of them are in different companies.
So,
Okay.
first of all, the term financial planner can mean lots of different things.
So
If you
Probably
had 5 fee-based independent financial advisors, certified financial planners, that sort of thing, you should be able to consolidate these without really any cost whatsoever. If you have 5 financial salespeople who sold you annuities and non-traded investments and that sort of thing, then you could have substantial penalties, fees by transferring.
And you didn't have a fiduciary financial advisor. You had a salesperson that said they were a financial advisor. So let's break it down. It's going to take us about 10 minutes, but let's break it down.
Okay.
What's the first financial advisor, and what product did that person sell you? If you
We'll call them financial planner A.
Okay. Started when my husband and I first got married, and put us in like some Roth IRAs. We're retired teachers, and so we started there. Okay.
Okay.
And how are they invested in this Roth IRA?
Is it in an annuity?
No.
Okay.
No. It's like most of these are 70-30.
Okay.
Yeah.
All right.
And where's the
then-
account held? Is it held at Charles Schwab? Is it held at
It
some
used to
mutual life
be-
insurance company?
I think it's Invesco.
Okay.
Okay. So he used to be with Kansas City Life, and then something happened and he changed. And so we went with him, but some of our Kansas City accounts had to stay.
Okay.
And so that's going to be person number 2.
Okay.
And same thing, 70-30, all of our things are about there. And then person number 3, my parents died. And so that I kind of inherited that person through my parents' financial records. Person 4 is through my in-laws after they passed away.
Okay.
And then the last person, a family friend, just said, this guy is a really good guy, and he just does some annuities, little stuff, maybe a little traditional IRA, not much with him.
All right. So number 5's out as a contender.
Yes. Okay. That's good to hear. Okay.
Number 2 is probably out as a contender because they work for a life insurance company.
Okay.
So they've got conflicts. They're there to sell their life insurance company's products.
Number 1 may be out.
Okay.
Is the firm that they work for, is it a fiduciary fee-based firm? Do they charge you a fee on an annual or quarterly basis in order to manage the money?
No, the only one that does that is number 4.
Okay. Well, there we go. That's where we'd start.
That's where I would start.
Okay.
Are they a certified financial planner or another similar designation? Do you know?
Certified financial planner.
Okay. And we'll tell you why we would start there.
Okay.
The other ones, first of all, our business is filled with inherent conflicts of interest. It so much so that if someone comes into the office and they have a mortgage of $200,000 and they have $200,000 to invest, if I say to them, take this $200,000 and pay off your mortgage, I will not receive any sort of a fee for doing that, even though it's in the best interest of the client, right? And so,
which is why sometimes advisors will just take the money. And matter of fact, oftentimes they'll encourage people to take loans on their securities because they make money, make doubling up.
Right? Or take a mortgage out of your house in order to invest it. It's an inherent conflict. And that's just an inherent conflict. Then you have a conflict of, do I sell products or do I get paid as a fiduciary to manage the money in your best interest?
And a fiduciary is just one who has a legal obligation to put your interest above their own.
Versus someone that is a commission salesperson has a, what do they call it, best interest?
And if I go to the Ford dealership, I'm expecting the salesperson to try to sell me a Ford. If I go to the Chevy dealership, I'm expecting the Chevy dealership to sell a Chevy. Someone who's purely independent, who works for nobody, is going to say, well, what are your needs, and try to find the best, kind of a similar situation.
And that's why out of all of them, the only one that you had in this list of 5s is that. So what you want to do is go to that person and bring them all of the contracts and statements that you have for all of these people. I've been an advisor for over 30 years. I don't take on, I worked, at one point in time, I had lots and lots of clients. I have 30 now that I've had for, the newest one's been with me for 20 years. One of them comes in 2 weeks ago, calls me up, says, Pat, I am the trustee of my sister's estate. She has things from everyone that blew by her house that stopped and sold them something. So there was an annuity from this. There was a mutual fund from this. It was this. They come in with
like
this,
a Kirby vacuum cleaner as well?
It was individual stocks that were worth $500, an annuity that had $160,000 in it. All these things. So we sit in a room, client service person with me. We go through each one of the files. Sell this, roll this one over, liquidate that. This, that, this. Looking at all the surrender charges and tax implications in any of the moves. Keep this one until she dies. We'll receive a step up in basis. It took us over an hour to go through all of the statements, and that isn't even starting the paperwork. The paperwork will take 15 hours.
Wow. Okay.
You need to do that.
And it'll make your life so much simpler once it's done.
You only have to communicate with one person. You know that they're going to charge you a fee. Typically, how much have you added all this up? How much money would there be in all these accounts, approximately?
Probably 800,000.
Okay, so you could expect that they're going to charge you between 0.9% and 1.25% of that on an annual basis. That's what you're going to charge. Okay. They shouldn't be charging you any transaction cost, anything like that. And they should be telling you how often they're going to meet with you. You should ask for a full financial plan to make sure that you know how to take the money out over time. What are the things you're missing? Should you pay off mortgages? Should you be gifting money to kids? That sort of thing. So ask for a full financial plan from this person.
Okay.
And if you want, just, take the podcast when you hear this on podcast and bring it into them and say this, just do what these guys on the radio on this podcast say. And that way you don't even have to explain it.
Sure. Okay.
All righty.
That makes a lot of sense. Yeah. It'll be a lot less more complicated than I want it to be.
And when you said you're a nice person, I was afraid you were sold a bunch of garbage. You weren't. It's just that happened to be, there were different situations occurred in life.
Yeah, you actually, there was a couple in there that I'm like, you'd have to dig into
Only
that.
one you kind of bought just because out of a relationship.
Yeah, but and there may be surrender charges on some of it, and the advisor will say, well, maybe it makes sense to hold this for another 2, 3, 4 years and then move it over, or maybe it makes sense for you to pay the surrender charge. But it's not that big of a deal. You've done fine. The most important thing you did is that you saved money and you didn't make some terrible mistake.
Right. Yeah.
All righty.
All of them are nice people. I just, hate to say no to people that are friendly and nice and have done okay for us. So, but it is getting more complicated.
Yeah.
You want to make it easier.
Will be a lot easier.
Most certainly, you want to make it easier on your heirs.
Yes.
Big time. That is the big time. That is the big time. Okay. Is when if something happens to you and your spouse,
and they're trying to figure out,
and then they're trying to figure it out.
A mess.
Right.
Mess. So appreciate the call.
Yeah, thank you, Renee. Wish you well. Well, hey, we want to take a moment, not have a call, but talk to one of our. She's more than an advisor, actually. She's our head of wealth planning, and Victoria Bogner. We've had her on many times. Yeah,
probably 3 times. 3 or 4.
Yeah, she joined us through one of our partnerships. We've talked about our partnerships in the past, and she joined us through one of our partnerships. She was CEO of an organization. Now she is our head of wealth planning, and basically makes sure all the advisors have the tools that they need, the resources they need, and I think she's part of a team also when there's very complex cases. Our advisors have a team of experts. Specialists on different areas. Like, here's this client with all these things going on. There might be 3 or 4 different specialists in the organization that they turn to get some additional advice on the planning. So,
and Vicki runs that.
Yeah.
So, and she's a CFP, CFA.
Et cetera. Victoria, thanks for joining us today.
Yeah, it's great to be back. Thanks, guys.
Yeah.
So we're digging into an interesting story today that is very common. And a lot of times we think of our clients as being older, and so they're asking us to help them with their kids. But a lot of times we also have clients that ask us to help with their parents. And that was this particular situation. We had a
Well,
client
I tell you,
who...
it is so common.
Yes.
Right? And a lot of people are getting squeezed both ends. They got kids in college and they got parents that they're dealing with. And sometimes the parents have the financial assets, but aren't necessarily making the best choices or having some cognitive issues. Anyway,
That's absolutely right. So in this situation, it was a client of ours. They're in their late 50s and their parents are in their early 80s. And so they're seeing a little bit of the handwriting on the wall to say, okay, well, while our parents do still have their wits about them, and also having the conversations of potentially, do we need to start thinking about assisted living, things of that nature, that their parents have been the classic do-it-yourselfers. This particular client, her dad has managed all of their assets, himself. But getting to the point where, and I've seen this a lot throughout my double-decade career, of parents pass away and it's an absolute jumbled mess because they didn't think ahead of what is the impact of all of my assets and how they're structured on my kids.
I talked to someone last week. The husband passed away. There was it 18 or 19 bank accounts at different banks?
Mm-hmm.
Just bank accounts. Just the bank accounts. I mean,
he was the bank accounts.
It makes no sense.
No, it made no
common.
sense. But
it makes things more complicated. But anyway,
so common. And so what's great is that we love working with the other generations, whether that's the kids or it's the parents. So we finally were able to have a meeting with the parents with this particular client involved, and later we were able to get the other siblings involved, which was great. But what's so interesting about these cases is that, first of all, they had a trust. Actually, two, because they had set up their estate plan prior to 2011.
Okay.
So,
Wow.
if any listeners
Wow.
know, this 2011 was a pivotal year when it came to estate planning because something called portability didn't exist prior to 2011, meaning that, first of all, the estate tax exemption was very low. And if you had a spouse pass away, you didn't necessarily automatically get to use up all of their estate tax exemption. So you had to do a lot of finagling with, setting up two trusts and having a bypass trust and all of these different things to be able to use up the total estate tax exemption of that first spouse.
Vicki, it's interesting you bring that up. And a lot of these trusts, particularly if you, like you say, before 2011, and if you go back even a few years before that, the estate exemption was a million, but it was 620 years ago.
625,000.
600,000 or something.
So I've seen a lot of old trusts that mandate this bypass, just what you're talking about here, right? And so,
yep. Yes. So
if trusts are that old, they need to be revisited.
Correct. So if you've made trusts prior to 2011, please talk with an estate planner or your estate attorney. They desperately need to be updated. And it's not like, I've had people ask, well, yeah, but what would happen if you didn't? It's like, well, it's like driving a 1991 Honda Civic. It might get you there, but it depends, No,
I recall dealing with a client years ago. They hadn't updated their trust. There was an automatic bypass. It wasn't necessary at the time. And there wasn't that. We actually had to put a portion of the primary residence in it because there wasn't enough other assets to fund this.
Yeah, because you want to fund it right up to that exemption amount.
Right. And we had this like, which is the worst kind of assets, because whatever goes in that bypass trust doesn't receive that step-up basis.
Correct.
Upon death.
Yes. Yeah. So nowadays we have something called portability, meaning that you don't have to jump through a bunch of hoops to use up that estate tax exemption of the first spouse. And you can do things like Q-tip trusts where, if it's a blended family, you can make sure that you're using the total exemption, but you're able to have your assets go to, say, your kids if you're in a second marriage, but your your spouse still gets to use distributions from those assets. So there are a lot of really cool things you can do with estate planning these days, but they're totally different than what you would do in 2010 or earlier. So that was an important component. And of course, they have kids and grandkids now that were not a part of the trust in any way, shape, or form. And this particular gentleman, bless his heart, and this is more common than you would think. So if you're a listener and you're thinking, wow, that is me, just know you're in good company. But he was a do-it-yourselfer, so he thought, well, if I want American funds, mutual funds, I'll open an account at American Funds. And if I want Vanguard, I'll open an account at Vanguard.
Oh,
And
my.
so
How
he
many
had-
accounts did he have?
Okay, you're going to fall out of your chairs. He had about 35 accounts
Oh,
spread
my.
throughout.
Oh.
All.
I made the comment about 18 or 19 bank accounts. This
Yeah.
is worse.
Yeah. So
This is
yeah,
2025.
Wow.
Exactly,
So do you
but-
think about how hard his taxes are every year? Forget when he died.
my
2026,
gosh.
you forget. I always forget the wrong way.
yes.
Beginning of the
Yes.
year.
Well, some of them are taxable accounts. Some of them were 401ks from employers from eons ago.
Was he missing
that
his
just-
required minimum distributions?
Well, no. So all of those I think were taken care of. But he did have, you've got your Roths, your IRAs, your taxable accounts, your old 401ks that are strewn all over the place. So as far as we could tell, RMDs were being taken care of. There were only, a couple of old 401ks and a couple of IRAs at different custodians. A lot of them were taxable accounts that were spread just all over the place. So you can imagine the 1099 nightmare this person must have had, their poor CPA. So what we did is like, okay, first things first, let's consolidate these and clean them up. Okay, so let's get them with a common custodian. We picked Fidelity, and let's just make sure all of these accounts, we just have one Roth. We have two Roths, one for each spouse, two IRAs. We'll move over the old 401ks, get those consolidated. We have, your taxable brokerage that we will put in the trust once we get that fixed, make sure the trust is funded. And that's the other component to this is, as a side note, if you have a trust, please make sure it's funded. So many times we see that you went through all of the effort to do this estate plan that's wonderful and beautiful, and then you never fund the trust.
And by
If you don't
funding
fund
it,
it's
it means you're
useless.
changing the title from, say,
Correct.
a joint to the trust, the revocable trust.
To the trust. The trust owns it,
And the
or
property.
the trust is the beneficiary. Correct. You need to retitle your properties to be in the name of the trust. Right. So that is incredibly important. So first we cleaned up all of these accounts so they're just in one custodian, which is beautiful. And we upgraded them to the beautiful world of exchange traded funds. So we were able to formulate a plan to sell out of some of these mutual funds in a tax-efficient way, because he did have low-cost basis in many of them, but get them changed over to something that's way more tax-efficient, which is just the exchange-traded fund kind of structure.
Yeah, and
over
much less
mutual
expensive,
funds.
too. Yeah.
And much less expensive, yes. So the next step is going to be, okay, now that we've cleaned this up and it's going to be so much easier for your kids, let's talk about legacy, values. What do you want to see as the through line? What do you want to leave as your legacy? Because they have about, $12 million in assets. So they're not in danger of violating the estate tax, exemption. That's about $15 million in 2026 per person. So $30 million for a couple. But that's still substantial assets that you want to make sure are passed on in the way that you want to see them used. Your values are still intact. And so talking through what matters to them. And then also a very important piece of this that I think is often overlooked, and I've seen this happen more than a handful of times, is that they forget about their other assets that are family heirlooms. So just recently, actually, I had a good friend whose grandmother passed away. She had jewelry that she had inherited from her great-grandmother, grandmother, all down the line.
Mm.
And this woman who passed away had 3 daughters. And after she passed away, she never communicated who
guess
got
what?
what piece
What
of
a
jewelry.
fight.
Yep.
Guess what? They are not speaking
That's
to
right.
each other
What
anymore.
a fight. That's a fight.
Yeah. So even more important is to realize you have these family heirlooms. People care about them and they have in their head, what they're going to get. And so putting in place something that details out, this person gets this, and it can be a legally binding document.
Yeah, and you could actually take pictures of them and reference that particular item.
That is absolutely right, which is the best way to do it. But then have the conversation with your kids while you're still here to say, I'd love for this child to get this for this reason. And I'm telling you, it will save so much
And by the way, if you can't do that, then what you do is you make equivalent value of the jewelry if there's 3 children that are going to receive it, and then you actually use a lottery to actually decide who gets what pile of jewelry. And I've done this with clients. And so we were like 3 equivalent. These we believe are all the same values. 1, 2, or 3, draw straws. You get those. They can trade among themselves, but it removes the parent from actually favoring one child over the other. It is all random.
That's a great suggestion.
It's all random.
I have not heard that
Then
before.
they fight over, is it straws or is it Rochambeau?
Well, that actually, but and that's why my family has never collected any family heirlooms.
There's no heirloom in my family.
Yeah.
We never got the Astor gene.
You didn't.
Let me ask you. So,
brooch
it's interesting.
Yeah.
So we talked about kind of the financial complexity here, but oftentimes people are quite private, right? So
yes.
And as we age, particularly private people, they've aged, they've got assets. Oftentimes they've never disclosed to their kids what their net worth is. How did that conversation come up? Because I'm sure a lot of listeners to this podcast have a similar situation where they don't know what the estate plan is that their parents have because their parents have been private about it, and it's not the kind of thing you really want to pry your parents about. But at some point in time, sometimes it becomes necessary. So how did this conversation come down?
This came about because the parents being in their early 80s, they were starting to have that conversation of, if we need to put mom and dad in assisted living, then what is that going to look like? And it's necessary then to see what kind of assets do they have that could pay for this potentially.
So someone broached mom and dad and started having these conversations.
That's right. And then when they realized, holy cow, there's a lot going on here, and dad's done it pretty much himself. They were just seeing the handwriting on the wall of, if something happened to mom and dad, this is a tangled web, and we need to get this untangled while they're still here and cognitively able to think through it.
That's right.
Yeah. And Vicki, at the end of it, how did mom and dad feel about the whole process?
Well, what's really great, and I'm proselytizing my team a little bit because I love them dearly. My team is so professional, but at the same time so kind. That for these particular clients, they spoke with one of my estate planners, and by the time they left, they were hugging her and telling her how much they appreciated her, that she took the time to just sit and listen.
I heard that could happen.
To them as they spoke, and they sent a letter to the advisor afterwards, thanking them profusely, specifically for her and how kind she was, and her gentle suggestions on what to think about, never making them feel badly about their situation at all. I mean, they've done a great job building up assets.
They don't spend any money. The parents probably don't spend any money.
That's correct.
You've seen these clients.
Of course.
100. We
have
talked
them
about
on
it
the
last
show
week.
all the time.
Yes. Well, thank you, Vicki. It's
always a pleasure.
And they're not easy subjects to talk about.
No, they're very personal.
Particularly, you get a really strong parent that's very private and it's none of your business. Go out and create your own life for yourself and all that. And
it makes sense to have the conversations. And if you did nothing other than actually take all those accounts and move them into a single brokerage account, if you did nothing other than that,
that would be
that would be a great start.
Yeah, that's absolutely right.
Redoing the trust is super important, though, too.
Oh, that's correct.
That bypass.
Correct.
That was very important.
Yeah, yes.
So if you find yourself or your parents in that situation, it's a good idea to get some help.
Yeah.
Well, thanks for taking some time to join us, Victoria.
Thank
All
you
right,
both.
thanks, Vicki.
Yeah, thanks.
Bye.
We're talking with Bill. Bill, you're with Allworth's Money Matters.
Hi, guys. Thanks for taking my call.
Yes, sir.
I am 70 years old. I've been retired for 6 years now. And what came in the mail was the 457B statement, which has a big pile of money in it, which we don't need to use. And so I'm 70. I'm thinking RMDs down the road whenever that comes up. It's like 72 or 73 now. I keep getting confused. And my first thought is to, when the time comes, just bite the bullet and pay the taxes and go on with my life. But I got a lot of money.
How much is it in a? You said 457B. Is it a 403B or 457? Which one?
It's a 457B.
Okay, thank you. And how much money is in it?
$580,000.
And how much money do you have in IRAs?
That's something we never ever did an IRA.
Okay.
Never ever.
That's fine.
I got a defined pension, and our combined pension is about $103,000 a year. And we also, because we didn't need it, we of course took Social Security at 67 and 66, so that's $61,000 a year rolling in. We don't have any house payment. That house is paid off. And we got other money in the banks, $174,000 in banks and credit unions, and then I inherited a brokerage account of $113,000 from my mom a couple of years ago. So that's just sitting there. So I'm running up against I got to do something, I suppose.
You don't have to. I mean, your required minimum distribution is going to be roughly 21, 22 grand, something like that, if you had to do it today. So let's assume you're 73. It starts. Your options at that point is, one, you can say, I'm going to have this go to a charity or charities. If that's the case, it's not taxable at all to you, the required minimum distribution. You could do up to $100,000 a year doing that. Option B is you pay the taxes, send the IRS their tax money, and you do whatever you feel like doing with it. You can stick it in your brokerage account, stick it in the bank, you can spend it.
Or you could convert some now to a Roth IRA prior to, but it's not going to make a bit of difference.
I wouldn't do that.
Yeah, I've kind of thought about that because I've listened to you guys a lot, and I go, well, it's kind of I'm not waffling. It's just that
it doesn't make any difference for you.
No,
it doesn't. It won't move your tax bracket one way or the other.
No, if you did any Roth conversion.
Yes, it's not going to move. It's not going to do anything to one way or the other. So
okay, it's pay him now or pay him later.
That's right. I wouldn't. I got to tell you, I wouldn't go through the hassle of converting to a Roth.
No.
Okay.
I wouldn't.
Yeah. All right.
I wouldn't. And if you give any money to charities at all, you want to do it out of your RMD.
Yes.
And can I also start education accounts for my grandkids?
You can, but it's not going to help you tax-wise.
No, but it makes me feel better.
Yes. No, that would be great.
Yes.
Okay.
No, that would be a wonderful thing. Because, you're in a situation, and this is a great place to be, right? And obviously, you've worked hard and get to this place, but you're 70. Most of your life's behind you. Hopefully, you've got a couple more decades. Nobody really knows.
Yeah, exactly.
Right? But you and your wife, we've got more assets than we need. It's what a wonderful opportunity for you to say, I want to help with my grandkids, however you feel like helping them.
Yeah, exactly. I'm going to.
And there's something to be said about doing it while you're here and can watch it and enjoy it, as opposed to
better from
being super tight with the buck, and then the kids inherit a bunch of your death.
Yeah, better from a warm heart than a cold hand.
No kidding. We've lived so long on the save mode that it's hard to get into the spend a little bit mode.
It is.
Although we did redo the bathroom finally. So
and I'm glad to hear that, Bill. I do have a question for you, though. I do have a question for you. On the brokerage account, when you inherited, did you reallocate it, or did you leave it just exactly what it was?
Pretty much where it was, and it's gone up a little bit, but not much.
You need to reallocate that. You need to reallocate it. You should have done it the day you received it, inherited it, because there was no tax implications in doing it. So you need to just scrub that thing down and
99% confident of that is that unless it came from some other bypass trust that didn't receive a step-up basis. But
yes, and I'm
99 less than 1% of the time.
And I'm 99% confident that you would benefit from a reallocation of that if you're like anyone else that inherits money. And the money in the bank, the 174, do you have it in a high-yield money market account?
Yeah.
Okay.
Pretty much. One's in the bank, some's in the credit union. It's kind of spread out.
Yeah, all right. Yeah, you should be getting 4 to 5% on that right now.
Yeah, that's about
Perfect.
what it is.
Perfect. The only thing I'd look at is the brokerage, and I love the idea of funding the 529. In fact, keep it in your name. If you keep it in your name, then if the kids need to qualify for benefit at some point in time, and you can actually name your children or your children, the grandchildren's parents, as a beneficiary on it when you die so that they can take over it.
Yeah.
All right?
Thank you. Thanks a lot, guys.
All right, Bill. Appreciate
it.
it.
Thanks. Appreciate it.
Bye-bye.
Hey, before we wrap up, I want to let everyone know about a webinar we've got, our January 2026 webinar. It's Inside a Multi-Million-Dollar Portfolio, a case study in advanced planning for 2026. So essentially, this is a case study webinar where we take you behind the scenes to take a look at how we helped one couple find some of their blind spots when it comes to their wealth strategy. And then we refined that approach for growth, for tax efficiency, and for long-term confidence. So this is being presented by Davis Blomquist. He's one of our certified financial planning practitioners and a longtime cornerstone of our education efforts. You might have seen him before, and I've done some things joint with him before over the years, which is kind of fun. But he's engaging. He's got an informative approach, and I think you'll find him not only educational, but somewhat, I shouldn't say entertaining, but similar to this program, it's like some of those financial topics can get dry, and so he's pretty good about keeping things engaging. But during this, what you're going to really learn is how we connected investment strategy, tax planning, and retirement planning into one coordinated plan designed to support some forward-looking decisions. Also, the tax-efficient tactics that households with this kind of multi-million-dollar portfolios often overlook, and how they can help optimize results over time. And the pivotal mindset shift that this couple made that really changed how they evaluated risk, opportunities, and the year ahead. So we're offering this workshop 2 more chances here. Thursday, January 22nd, and Saturday, January 24th. You do need to register for it. Go to allworthfinancial.com/workshops. Well, that is all the time we've got today. Hey, if you like this program, we're just going to ask a couple things. One, make sure you follow us. Hit the follow button. That way you'll automatically get it each week. So you make sure you get it in your inbox. And while you're there, give us a little rating. And
you don't have to write a review, but you can.
Yeah.
Or you could just give us a rating.
Give us a rating.
So at the minimum, please just do the rating, because our marketing people tell us that we're really close to the tipping point.
Another 20 years, and maybe we'll hit that.
We will be an overnight success in less than 20 years.
And if there's sometime a program that's particularly interesting, you think a friend could benefit, forward it on to them as well. So anyway, we'll see you next week. This has been Scott Hansen, Pat McLean of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.